I think if you're a physical silver buyer, you got to buy it now while the product is available, while we can get it. And I hope a lot of people took advantage of it before it left, while it was here. In fact, all last year, I told people, buy 30. 30 is the new 20. Silver's not going below 30. Then I said, buy 40, 50. Now I'm telling people to buy $70 silver if you get the opportunity to buy $70 silver. The low of the pullback after silver got above 83 was just above 70. And ever since silver got above 80, it's never been below 70. I wouldn't wait for 71 or 72. I just buy it at 79, because here is the problem for long-term silver buyers. I'm talking about physical silver. I'm not talking about people who want to trade it on the COMEX. I believe support is now 70. I don't think we're going down to 50 at all. The opportunity to buy $50 silver is gone. You're up 4.6% already. Silver is up about 12.5% so far in 2026. So silver got as high as $83.50, 60 some odd cents, not quite up to 84. Now, it didn't hold those gains into year end. It ended 2025 at about $71.50, but that was still about 145% higher than where it began the year. So huge move up for silver. But other precious metals, platinum too, was up about the same amount. I forget the exact percentage. I think it was around 140, 150%. I mean, it began the year below 1,000, even though gold was at 3,000. And of course, it's still cheap relative to gold, but not nearly as cheap as it was. And of course, silver was well over 100. I think the low was 108 or something like that, ounces of silver for 1 ounce of gold. So I was pounding the table on these other precious metals earlier in the year, knowing that they were bound to catch up. And we've seen that move. I don't think the move is over. But to me, the movement now in the rest of the precious metals complex, this is not just a gold bull market. This is a precious metals bull market. And one of the knocks on the gold bull market, one of the reasons that a lot of people were skeptical and didn't believe it, was because the other precious metals weren't participating. You weren't getting the confirmation of the gold rally in silver.
Here's the part most headlines skipped. Silver didn't just rise, it corrected a decade-long distortion. When silver gains 145% in a year, while the gold to silver ratio collapses from over 100, that's not speculation, that's repricing. As Peter Schiff has argued for years, silver's underperformance was artificial, driven by paper markets, not fundamentals. Platinum's matching move reinforces this wasn't a one-metal fluke. Investors who dismissed gold's rally because silver lagged were using a false filter. Confirmation arrived late, but when it did, it arrived violently. And that timing matters more than the price. What Peter Schiff says next explains why this confirmation changes portfolio risk entirely.
Well, now that's not the case. Silver has certainly confirmed, as has platinum, that this is a precious metals bull. This is not just limited to gold. And precious metals are strong for a reason. This is not random. This is happening for specific reasons. And those reasons are getting stronger in 2026. In fact, 2026 is already off to a stronger start than 2025. Gold closed this week on a positive note, up just over $30 an ounce. We closed at 4,508, so above 4,500. Silver didn't quite close above 80, although it traded above 80 again this week. It traded above 82.50, but it was up almost $3 on the day, closing just below 80. I think it was 79.84. But percentage-wise, gold is already up 4.6% this year. This is only the 10th of the month, 10 days into the year. Of course, most of them weren't even trading days because of the holidays and the weekends. But you're up 4.6% already. Silver is up about 12.5% so far in 2026. So just picking up where last year left off, the precious metals bull market continues. Platinum, again, up about the same amount, I think, as silver. Also, look at what happened with the mining stocks. Because another knock on the gold bull market was the lack of confirmation in the mining stocks, because the mining stocks were lagging.
This isn't momentum, it's acceleration. A 4.6% gold move and a 12.5% silver move in the first 10 days of the year annualizes into numbers Wall Street rarely models honestly. As Peter Schiff has pointed out, early year strength often signals institutional positioning, not retail chasing. The key detail here is breadth. Gold, silver, platinum, all moving together. That's classic liquidity rotation, not speculative froth. When metals lead this early, it usually precedes stress elsewhere in the market. And that's why mining stocks suddenly matter again. Next, Peter Schiff explains why miners lagging was never bearish. It was fuel.
They're supposed to be leading. Mining stocks are supposed to be stronger than the metal in a bull market. That wasn't the case. But of course, that's why I was pounding the table, especially early last year. In fact, I put out a special report, I think in April, the best way to buy gold, and that was buying gold stocks, because gold stocks had barely gone up on the year, even though gold was above $3,000 an ounce. Well, the GDX, which is a gold stock index, finished the year up 153%. And the GDXJ, which has some mid caps, more mid caps, it's called juniors, but they're not really juniors. They're just a little bit smaller than the GDX. That index was up 166% last year, and off to a strong start again this year. The GDX is up 8% so far in 2026, and the GDXJ not that much farther behind, up about 7.2% so far on the year. But these stocks are now outperforming the metal itself, which means now everything looks like a bull market. You can't say, well, you're not seeing a confirmation in silver, because we are. Oh, we're not seeing it confirmed by the mining stocks. Well, we have. And in fact, one thing about the mining stocks is that even though they've outperformed the metal, they didn't outperform it nearly enough. Given how much gold and silver prices have risen and how great an impact that's going to have on earnings of these mining companies.
This is where valuation math breaks Wall Street narratives. A 153% move in GDX sounds big, until you realize gold prices doubled margins for miners, not revenues. Historically, miners lag early and explode late. 2001 to 2003 showed the same setup. Earnings leverage hasn't been priced in yet, which is why Peter Schiff keeps calling this a discounted cash flow anomaly. If miners were truly expensive, insiders wouldn't still be holding. Next, Peter Schiff talks the confirmation argument is dead, but the repricing phase is unfinished.
Stocks are still very cheap. And that's still, to me, a positive contrarian indicator, in that the investing public still doesn't appreciate how cheap these gold mining stocks are and silver mining stocks are. They still don't get the significance of the bull market. They're still distracted, by the tech bubble or the crypto bubble, and they're not really paying attention to this opportunity, which is why investors should still be buying not only physical gold and silver at these prices, but especially the mining stocks. And, the gold mining stocks, not only are they going to make a lot more money because the price of gold is going up, but look at oil prices. Oil prices are below $60 a barrel. They're about $58 a barrel. That is the most significant cost in gold mining is energy. And that's going down. Now, I don't think oil prices are going to stay down, but they're down now. So this is great for the profits of the gold miners. But also, silver going up is going to have a major impact on gold mining companies, because pretty much all the gold mining companies mine some silver. It's a byproduct of gold. And the way they report it, it's not earnings from silver mining, but the money they get from their silver, they use that to offset the costs of mining the gold. So that means not only are mining costs going down because of low energy prices, but because they're getting so much from their silver byproduct. That is dramatically reducing the cost of their gold.
This is where fundamentals quietly overwhelm sentiment. Energy accounts for roughly 25 to 30% of mining operating costs. And with oil under $60, margins are expanding without any heroic assumptions. Peter Schiff says, add rising silver byproduct credits, and effective gold production costs collapse, a detail most earnings models ignore. While investors chase AI multiples and crypto narratives, miners are improving cash flow invisibly. That's why contrarian setups work. Capital flows late. The risk isn't owning miners here. It's realizing why Wall Street hasn't noticed yet. Next, Peter Schiff shifts to what happens when the crowd finally does. And the next point explains why costs matter more than price right now.
And it is going to be reflected in their earnings. So all the gold stocks are going to benefit from higher silver prices, even though people aren't buying them because they're silver miners. They still mine a lot of silver, and it makes a big difference on their net costs of mining gold. And of course, there are companies that just mine silver, and they were the star performers of 2025. But again, given how cheap they were when the year began, they're still cheap now, despite tripling and quadrupling on the year. So even though we've seen this rally, you want to buy gold, you want to buy silver. Gold, I don't think there's very much downside risk at all. I don't think gold's going below 4,300. So if you're buying it now at 4,500, I think there's minimal downside in gold at 4,500, right? Silver, a lot more volatility, which to me makes sense given the magnitude of the breakout, right? You know, we blew through 50. I mean, we basically paused there for a couple of weeks maybe, and I was forecasting on this and on my main podcast that once silver broke above $50, it was going to be a moonshot and that 50 would be support. Well, 50 was only support briefly. I believe support is now 70. I don't think we're going down to 50 at all. The opportunity to buy $50 silver is gone.
Everyone talks about silver prices, but almost nobody talks about how silver quietly rewires gold miners' earnings models. What Peter Schiff's outlining here is a margin story Wall Street rarely prices incorrectly. Higher silver prices, lower effective gold production costs for diversified miners, boosting cash flow without headline gold moves. In 2025, several primary silver miners tripled or quadrupled, yet many still trade below long-term valuation multiples due to how underpriced they were at the start of the year. As Peter Schiff has noted repeatedly, breakouts through decades-long resistance zones, like silver clearing $50, often reset the entire valuation floor, not just price targets. The claim that $70 is now support reflects that structural shift, not hype-driven volatility. What Peter Schiff says next reframes why waiting for pullbacks may no longer work the way investors expect.
And I hope a lot of people took advantage of it before it left while it was here. In fact, all last year, I told people buy 30, right? 30 is the new 20. Silver's not going below 30. Then I said buy 40, 50. Now I'm telling people to buy $70 silver if you get the opportunity to buy $70 silver. The low of the pullback after silver got above 83 was just above 70. And ever since silver got above 80, it's never been below 70, although it's gotten down there. I think the real support zone is 71 to 75-ish. So that's probably the best place to buy it. But the problem is, I wouldn't wait for 71 or 72. I just buy it at 79 because here is the problem for long-term silver buyers. I'm talking about physical silver. I'm not talking about people who want to trade it on the COMEX, doesn't really matter. I'm talking about if you want actual silver delivered to your house like we do at Schiff Gold, you just got to buy it now. And that's because I expect the premiums on silver products to soar in 2026. So you've got two things that are going to happen. You got the price of silver is going to go up, but the premium on the products, what you have to pay to actually buy a 1 ounce coin or, a bar, is going to go way up because of the supply disruption.
This is where price charts stop telling the full story and physical reality takes over. Peter Schiff's pointing out something traders often ignore. Spot price is only half the cost equation for real-world silver ownership. Historically, during tight supply periods like 2008 and 2020, retail silver premiums surged 30 to 50%, even when spot prices pulled back. As Peter Schiff has warned, waiting for perfect entries can backfire when premiums explode faster than price corrections materialize. The $71 to $75 support zone may exist on charts, but physical buyers face a different market governed by inventory, mint capacity, and delivery constraints heading into 2026. That's a structural mismatch Wall Street pricing models don't capture. What follows is his most direct warning yet about looming shortages.
There's simply not enough physical silver being mined to meet the demand that we're going to see. China already has an embargo. They're not exporting any silver, and they're the world's largest producer. Investors are now starting to wake up to what's happening with silver, and there's just not enough of it. So the premiums are going to go up. So even if you get lucky and you wait for silver to pull back to 71 or 72, by the time it does, the spread or the premium that you have to pay on the products may have widened by so much that it's actually more expensive. So I think if you're a physical silver buyer, you got to buy it now while the product is available, while we can get it. I mean, I have a feeling that later in the year, we're going to be out of stock, right? You're going to want to buy physical silver. We're just not going to have it to deliver. That's going to be the problem. Or maybe we can get it to you, but the delivery times are going to be later. Right now, what I can tell you is we've got the supply. We haven't had to really increase the premiums. So it's available. Buy it. Buy it while it's available. Now, of course, if you don't need physical delivery, that's not as big an issue. And of course, I still think that everybody should open up an account with T-Gold. That is the part of Schiff Gold that deals with the storage program that we're doing, that we're going to build up to an e-commerce platform where you're going to be able to take delivery of tokenized gold and tokenized silver probably too.
This is the part most headlines won't touch. Supply controls don't show up on price charts until it's too late. China, the world's largest silver producer, restricting exports is a material shift in global supply dynamics, not a footnote. According to the Silver Institute, annual silver deficits have persisted for multiple consecutive years, with investment demand rising as mine supply stagnates. When physical availability tightens, premiums widen first, inventories vanish next, and only then do prices gap higher. Peter Schiff's warning about delivery delays mirrors what investors experienced during past commodity squeezes, when paper supply remained liquid while real metal disappeared. And what Peter Schiff adds next shows how custody choices may matter as much as price.
But right now you can buy gold and silver and not take delivery and leave it on the T-Gold platform. So you can do that too. But when you're buying for your own storage, for your long-term, self-custody, you just got to buy. Forget about the fact that it's $79, $80. Just be glad you can get it, because silver is going to be very, very scarce very soon. And the price, I think, will be a lot higher.
This isn't about chasing price. It's about securing access before scarcity reshapes the rules. Peter Schiff's separating speculation from ownership, emphasizing that custody decisions change risk exposure more than short-term price swings. History backs this up. During supply crunches, unallocated or pooled systems function normally while self-custody markets seize up. As Peter Schiff often points out, scarcity doesn't announce itself politely. It shows up as delays, rationing, and sudden repricing. Paying $80 instead of $70 matters far less than being unable to source metal at all. For long-term holders, availability becomes the real asset. And that scarcity theme ties directly into what comes next in the cycle.
Gold was under 300, and now it's over 4,000. silver was under $5, and now it's $80. So yes, in terms of dollars, the Dow has gone up. But in terms of real money, in terms of gold and silver, the Dow has gone way down. See, that's one of the reasons that politicians love inflation, because they can claim that we're getting richer even as we're getting poorer. Because it's easy to make the stock market go up if you're measuring it in currency where you destroyed the value. So if you debase the dollar, oh, look at how expensive the Dow is. Yes, but look at how much more expensive gold is and how much more expensive silver is. Those trends are not only going to continue, where U.S. stocks continue to fall priced in gold and silver, but they're going to fall even more. It's going to be an even bigger decline this year, I think, than last year. And maybe because instead of an up year in stocks, 2026 is a down year. Would not be surprised at all, especially in the NASDAQ, to see the U.S. stock market go down in a year where gold and silver continue to go up and where gold and silver stocks are up even more. Don't wait to Monday to buy your gold and silver from Schiff Gold. Buy it Friday night, Saturday morning, Saturday day, Sunday morning, just any time before Asia opens for trading Sunday night, because I think we could see another huge move up in gold and silver on Monday.
Measured in dollars, stocks look fine. Measured in real money, they've been quietly bleeding for decades. What he's exposing is the inflation illusion politicians and markets rely on. Nominal gains masking real purchasing power losses. Since 2000, the Dow priced in gold is down over 70%, even as headlines celebrate record highs. As Peter Schiff has pointed out, asset inflation is not wealth creation. It's currency dilution. If 2026 delivers a risk-off year for equities, especially the NASDAQ, this divergence could accelerate sharply. Gold and silver rising alongside falling stocks would break the comfort narrative many investors still cling to. Next, Peter Schiff shifts from diagnosis to urgency. And timing matters more than it seems.
So don't wait for the crowd. Beat the crowd. Buy now. Don't forget about the new program at T-Gold to have some gold and silver that you could use as a medium of exchange. You could use as commerce, set up debank yourself and use real money instead of fiat money. Oh, and I totally forgot to mention Bitcoin. I can't believe I was going to mention it. I'll mention it now because Bitcoin was down last year. It was down about 8%. Last year was the year that gold reclaimed the center stage. It had been upstaged by Bitcoin. No more. Bitcoin was down. And in fact, gold and silver are outshining Bitcoin again already in 2026. The big loser in 2025 was MicroStrategy, down about 48%. It's barely recovered anything so far this year, a few percent. I think that stock's getting killed this year. I think it'll have a bigger decline in 2026 than it had in 2025 because Bitcoin, I think, could do a lot worse. And that's going to be why a lot of institutional money gets into gold and silver, because they're no longer going to be distracted by Bitcoin. It's not so much that they're going to sell their Bitcoin because they don't really own it, but it was clouding the whole gold story. People were thinking, why buy gold if Bitcoin's going to replace it? If Bitcoin is the new gold.
The real story isn't Bitcoin falling. It's gold quietly reclaiming institutional attention. In 2025, Bitcoin dropped roughly 8% while gold surged, exposing the fragility of the digital gold narrative. So MicroStrategy's nearly 48% decline shows what happens when leverage meets volatility, something institutions are paid to avoid. As Peter Schiff has argued, gold's role isn't growth, it's balance sheet insurance, and that matters when liquidity tightens. If Bitcoin weakens further, in 2026 capital doesn't rotate into cash. It looks for stability, and that's where gold and silver regain relevance. What Peter Schiff explains next is why exits may not be as easy as people assume.
So that kind of, tainted the whole gold narrative. And yes, some people who did buy Bitcoin through Bitcoin ETFs, they're going to sell to buy some gold ETFs and to buy some gold stocks. The problem is only a few can get out. Because once, I think, a significant number of people try to sell, the market's going to implode. The bottom's going to drop out. And so that money's just going to evaporate. But now gold is going to have the safe haven, store of value story to itself. It's not going to be upstaged by Bitcoin. Last year was proof that Bitcoin is not digital gold or digital silver, but the market didn't react to it. 2026 is going to be the year where the Bitcoin is digital gold narrative falls apart. It was proven false last year, and then investors are going to react to that proof this year. And I think those of you who are still holding and hoping, aka the hodlers, get out of your Bitcoin. In fact, you could use Schiff Gold to do it. We do work with BitPay, and we make it very easy to get rid of your fool's gold and buy real gold and silver, or buy through T-Gold on the Schiff Gold website. So China didn't need the United States. It's the United States that needs China. We need China for their products, and we need them to loan us the money. That we need them to buy our treasuries.
Liquidity is generous on the way in and brutally selective on the way out. Peter Schiff's highlighting a structural risk most ETF buyers ignore: exit congestion. If enough Bitcoin ETF holders rush for the door, price discovery doesn't descend smoothly. It gaps lower. As Peter Schiff has warned, assets that depend on continuous confidence collapse faster than fundamentals can explain. Gold, by contrast, doesn't require belief, only acceptance. If 2026 forces investors to confront Bitcoin's failed digital gold test, reallocations will favor assets with centuries of trust behind them. Next, he connects this shift to a much larger global funding problem.
And that is the other big problem that you're going to have. Look at the yield on the 10-year Japanese government bond, over 2.1%. I predicted last year that the yields on the 10-year Japanese government bond would rise above 2%. They were less than 0.5% when I made the prediction. But rising yields in Japan is going to put a lot of pressure on the Japanese government to sell US Treasuries. They are the largest holder of US Treasuries right now. They're going to be selling. They're not buying. And, of course, the rest of the world is not buying Treasuries. They're selling. They're buying gold. They're going to buy more gold. I think central banks will buy more gold in 2026 than they bought in 2025. Not just the central banks that have already been buying, but other central banks who stood by and didn't buy. While other central banks did, they're going to buy, right? They're going to be FOMOing into the gold because they're going to need gold as part of their reserves. I mean, gold last year replaced the treasuries as the largest reserve asset of central banks. That is going to continue. That trend is a massive and important trend that is going to be going on and on for many, many years. And that is also going to fuel demand for gold.
This is the bond market warning almost no equity investor is watching closely enough. Japan's 10-year yield breaking above 2% is seismic, when you remember it sat near zero for decades. As the largest holder of US Treasuries, Japan shifting from buyer to seller tightens global dollar liquidity. Central banks already bought over 1,000 tons of gold in 2025, according to the World Gold Council, a record pace. When reserves rotate away from treasuries, it's not ideological, it's defensive. That structural demand doesn't reverse with headlines. And next, Peter Schiff explains why retail investors won't stay on the sidelines much longer.
But now you're also going to have individual investors really stepping up their demand. They were pretty much absent last year. They're not going to be absent this year. This is going to be the year that Wall Street wakes up and discovers precious metals and the precious metals mining companies. So everything is bullish. And I think, Donald Trump's foreign policy is also going to backfire, just like the tariffs are backfiring, alienating our friends, alienating the countries that we rely on to supply us with goods that we don't produce, to loan us money that we don't save.
Retail money usually arrives late, but when it arrives, it changes market behavior fast. Individual investors largely sat out precious metals in 2025, but history shows participation spikes after institutional positioning is already established. As Peter Schiff has noted, cycles turn when psychology shifts, not when data first changes. If geopolitical tensions and trade disruptions continue to pressure supply chains and capital flows, metals and miners benefit from both fear and fundamentals, Alienating trade partners doesn't reduce dependence. It exposes it. That's when portfolio insurance stops sounding optional.